Good afternoon, everyone. Oh, that's pretty peppy. Huh? It was like you see those TV shows where like there's a classroom where the teacher starts like, "Good morning, class," and the students are like, "Good morning, Dr. Barnes." I was like, if that ever happened in reality, I think I would just be like Twilight Zone type experience. Yeah, so don't get any ideas. All right. We are doing chapter 7 today. Going to talk a little bit more about internal controls because 1 week for internal controls is not enough. We have to have at least one more lecture on internal controls. What we're going to be talking about on Wednesday also, we'll have some internal control significance. So kind of 2 weeks on controls. Good times. Some announcements. As I've mentioned a few times already, on the 6th, so a week from today, we're going to Spire Energy. I still have some spots open for lunch if you'd like to join in. Just let me know. Also, I'm going to go ahead and make this announcement. We're not really doing anything with AI, but by regardless of my intention, I became the AIS instructor, and so Dr. Caden invited me to know about this group. It's called True Up. They're a education gamification company, which, if you don't know, it's basically games and education type things. And they're doing a competition called Race the AI. And the explanation will talk a little bit about it a little bit more, but basically it's a scenario where there's a rogue AI that's in your accounting system, and you've got to figure out what it's done to figure out the system. So you're going to be using AI tools in kind of a game context. It's going to be starting in middle of October and going on for about 2 weeks. If you have any interest in this, please let me know. Truman has been authorized to have two teams compete in this competition, two teams of four. And so I'm just petitioning, see if there's any interest in it whatsoever. There's no obligation, but if you have an interest in it, obviously it's great experience. But the first team, winning team of this competition, is going to receive $3,000, which currently there's only 7 schools signed up, so not a whole lot of teams, so pretty good opportunity. Yeah, and with that, we're going to start on chapter 7. So a little bit of reiteration about what we talked about last week. So remember last week we talked about controls just a very general level and what auditors' responsibilities are with respect to controls. We're not going to abandon that, but we're going to go into a little bit more depth on a certain aspect of it. So if you recall, we've got our COSO cube, and one of the parts of the COSO cube have to do with the 3 objectives of internal controls: reliability of financial reporting, effectiveness and efficiency of operations, and compliance with laws and regulations. Now, I know it's been a week, but I'm guessing that you still hold on to this because you listen to everything that I say with bated breath and write it down and memorize everything. That's just what I expect of you all. But which one of these is most critical to a financial statement audit? Reliability of financial reporting, because as we know, the goal of an audit is to make sure that financial statements are free from material misstatement. So anything that contributes to financial reporting is going to be our focus of our audit efforts. Now, I want to reiterate a point I made last week. This does not mean that the other two are completely easy to ignore. We can't ignore those completely as an audit, but the ones we're going to focus on most closely are going to be the ones related to controls over financial reporting. And that's the focus of this chapter. We're going to go in a little bit more depth. So where does this emanate? What does the idea behind this emanate from? And it has to do with something called, you may have heard of it, the Sarbanes-Oxley Act of 2002, specifically Section 404. Now, this has always made me laugh that this is the section they assigned with this, because if you ever, in the early days of the internet, 404 was the type of error where a file was not found or a website was not found. And so I always just kind of think of that when I think of 404, is that it's so vague that nobody can find it. But Section 404 has some pretty premium dictates with respect to internal controls. Specifically, it requires managers of publicly traded companies to do 2 specific tasks. They have to issue a report that accepts responsibility for establishing and maintaining adequate internal controls over financial reporting. Now, you may say, what is the difference between that and internal controls? And the answer is that for other controls, they just basically have to take responsibility for them, but there's not a direct report issued that assesses that responsibility. Now, just as a reminder, this is Sarbanes-Oxley Act, which is only relevant to publicly traded companies in the United States. All right. And this criteria has actually has a certain threshold that it has to be met. I believe currently the threshold is $100 million in annual revenues. So it has to be larger companies. That being said, if you do meet that criteria, if you're a company that's got at least $100 million in annual revenues, you have to, and you're publicly traded, your organization has to issue a specific report that management takes responsibility for internal controls. Also, they have to make an assessment as to whether the internal controls over financial reporting are effective as of the end of the fiscal year. So issue the report and make an assessment in that report saying, we believe the controls are operating effectively. Now you can kind of see where this is going. You can kind of see this is what management's responsibility. Obviously, if we're going to be talking about the auditors have got responsibilities related to this. Section 404 also requires the auditor to audit management's assessment of the effectiveness of internal controls or financial reporting. This actually results in a separate audit report with respect to internal controls or financial reporting. Now we've seen a little bit, or we've talked a little bit about this already. We've talked about audit reports. The audit reports we're going to focus on chapter 18 are financial statement audit reports. We're not actually going to take a look at controls reports simply because I don't want to overwhelm you, first of all. And secondly, because they're fairly straightforward. There's not a whole lot of nuance or subtlety to them. It's just basically kind of slapping in the face, controls are operating effectively, so on and so forth. So PCAOB auditing standards 2201 actually makes the statement the auditor must conduct the audits of financial statements and internal controls in financial reporting in an integrated way, because each audit provides the auditor with information relevant to the evaluation of the results of the audit. Now, we're going to talk a little bit more about that in detail shortly, but what this means is that when auditing a public company, an auditor, and again, this is when I say this, I just want to clarify, whenever I say audit of a public company, this is assuming that they meet the criteria for auditing under the Sarbanes-Oxley Act, Section 404. The auditor has to perform something called an integrated audit. And if you hear the term integrated audit, that means that they are required both to test the financial statements, audit the financial statements, and to audit internal controls over financial reporting. In other words, we cannot bypass internal controls testing in this area. We are required under Sarbanes-Oxley Act to test the internal controls in this area. So remember last class period or last week when we were talking, I was saying, sometimes if you don't really want to test controls, you can go ahead and ignore the controls and you can do substantive testing instead. That does not apply here. If it's controls related to financial reporting and they're required to be tested under the Sarbanes-Oxley Act of 404, we as auditors have to test those controls, regardless of whether we think it's efficient to do so or not. We are required to do so. And just as a reminder, I'm going to say it many times, but it's not necessarily as present on the slides as I'd like it to be. We are going to issue a report on these controls. We're going to issue an opinion on these controls. So there's going to be a separate opinion on internal controls over financial reporting, which now is interesting because now we have an audit opinion about the financial statements themselves. And we've also got an opinion about the internal controls over financial reporting. Now, this leads to an interesting question. Is it possible that we could have one opinion that says that everything's fine and another opinion saying there's a problem? Like, could I have an audit report over financial statements that says financial statements are free from material misstatement and all material respects? And then could I have a similar another report that says the controls are not working, the controls are problematic, and adverse opinion, we believe the controls are not operating effectively? Is that a possibility? Yeah, remember, this goes back to this idea of what I talked about in the very first lecture, where I said you can still have a delicious cheeseburger that you don't want to eat, okay? Because you can have controls functioning properly. It doesn't matter if the cheeseburger is delicious. You're going to say, I'm not eating that cheeseburger. I know what's on it, okay? I'm not going to remind you, recount what happened to that cheeseburger. If you don't remember, go back and watch the first lecture. It was a grim day that day. All right, because any day I can't have my cheeseburger is going to be a sad day. Anyway, so that's basically what we're trying to talk about. Is these are two separate considerations. Now, logically speaking, it would be great for most organizations to have good opinions both on financial statement reporting and financial statements and on their internal controls. So that's going to be our optimal goal. But as we'll see, we can issue opinions that are going to be not necessarily consistent for either report. Now, a little bit of refresher, something that we talked about last week is we talked about the control deficiencies defined. And this is something I threw in at the end of, I believe it was the second lecture. So when we talk about a control problem, a control failure, we consider that to be a control deficiency. And this is the general term that we use for any control failure. This is also our lowest category of control failure. If we think that it's a control failure, but it's not necessarily substantially problematic, okay? This is a little bit like you're vacuuming the floor and you miss a little bit of dust in the corner. It's not a big deal, all right? Should it be something that you fix? Yeah, you probably should vacuum thoroughly, but it's not going to be an issue. Control deficiencies can come up in one of two ways. All right. There can be a deficiency in the design of internal controls and a deficiency in the operation of internal controls. Now, we've talked about these already, but a deficiency in design basically means that they're not present or they're not designed properly. Like the implementation of them is problematic. They were not created in the first place or created correctly in the first place. The deficiency operation is a little bit different. You have controls that are functional, and if they were followed, they would be effective. But for whatever reason, they are not operating properly. This is the example. The example I gave for this one is that you have segregation of duties, and the segregation of duties that you've set up is really, really good. But people in that area are like, you know what? It's too much work to follow these controls. Here's my password. You can go ahead and just go ahead and record these journal entries for me. The control is functional, but it's not being followed. Okay, it's not being followed properly. Therefore, it's not operating effectively. Now, this is kind of our general terminology. What we're going to find out is what we're really concerned about with respect to internal controls of financial reporting is how severe these failures are. And we've got two specialized terms for this. We've got significant deficiency. Significant deficiency at a very basic level means that it's significant but not material. It's not likely to result in material misstatement. Now, the important thing to note about a significant deficiency, and what I always throw out there is, a significant deficiency is something that, if left unchecked, will likely become a problem in the future. So the example I use this, and this is really embarrassing because I have to tell you about how much of a slacker I was when I was a kid. So my family, when I was about when I was in my about 10 years old, like 9 or 10 years old, they bought this big blue van. It's like a big blue box van that you see from the 1970s. Okay. And it was actually pretty nice inside. It was carpeted. It was made, basically we put together for big long trips with as a family. But when I turned 16, my father had another car. He says he gave me the van and said, "Okay, it's yours now. Take care of it." And that's what I drove to school, which was actually kind of cool. But I was a big slacker when I was a kid, and I was like, I didn't really take care of the stuff. And so my friends noticed, "Hey, the engine light's on." It's like, it always does that. It says, "Maybe you should add some oil." I says, "Nah, it's not a big deal. It'll tell me if it needs to add oil." It was telling me I needed to add oil. That's what the engine light was saying. Okay. Can you drive a van in the short term without any oil and suffer no consequences? Yes. Okay. In the short term, that's not an issue. Guess what happens if you continue driving it without putting oil in it? Yeah, it breaks down. Guess what happened to my van after a while after driving with no oil in it? Yeah, it broke down because I was not very good at taking care of stuff. I was kind of a scallywag. Yeah. So yeah, that's an example of significant efficiency. Not a problem in the short term, definitely a problem in the long term. All right. Then we have material weakness. Material weakness is basically saying this is a control failure that is likely to result in a material misstatement. Now we're going to reiterate these points. We're going to have some examples of these points and talk a little bit about these, but this is kind of our spectrum for analysis. And I couldn't just leave this slide unchecked. I had to throw it there. When you buy some cloth, make some curtain, you accidentally rip the cloth. It's a material weakness. Yeah, that's kind of the kind of thing I'd see Dr. Eisen say. I can't really do his voice. Yeah, you rip the cloth, you know? Yeah. That was more Seinfeld than Dr. Eisen, you know. I'm sorry. I'm sorry. No more Dr. Eisen, no more Dr. Eisen impersonations, at least not this week. All right. I say that I'll probably impersonate him on Wednesday. So how do we determine whether something is significant deficiency in a material weakness or a control deficiency for that matter? Well, we're going to consider on two possible criteria. We're going to have two dimensions that we're going to evaluate. The first dimension is likelihood. The second dimension is magnitude. All right. And this is kind of the way that we would consider it. So you've seen concepts similar to this before. It's not particularly foreign, but you do need to follow this through a sequential process. It is a sequential series of steps. So let's think about likelihood. In likelihood, we have to have a situation that is at least reasonably possible or probable to result in a material misstatement, a failure that's reasonably possible or probable that resulting in a misstatement. All right. If it's a remote possibility of anything bad happening, we don't consider that a control deficiency to any degree, regardless of how effective the control is or not. So an example, okay, let's consider a meteorite hitting the Earth. We currently had zero controls in place we don't have Bruce Willis and his team, ready on a rocket ship to destroy a meteor. Has anybody ever seen Armageddon? Is that like a really old school movie that I'm just kind of like, I kind of think of that as still a fairly recent film, but it was probably like late 90s. It's almost 30 years old. Man, I'm old. All right. So yeah, meteor, we don't have any meteor controls. All right. So is that going to be a significant deficiency or material weakness for our planet? Probably not, because the last time we had a meteor of any significant impact was like 65 million years ago. And none of us were around back then, okay? The dinosaurs probably were not too happy about it, but that's their fault for not implementing proper controls for meteors, okay? So yeah, that was their fault. No controls in place. Yeah. So that's going to be the idea of likelihood is that if it's a remote likelihood, we don't really concern ourselves with it, regardless of how severe it would be. If we believe that it's at least reasonably possible or probable of happening, that's where we're going to consider it at least a control deficiency. A control deficiency is not materially significant, but it's still a problem. And we're going to report this to management. By the way, this is probably the most important column in this entire graph because we're going to reiterate this many times already. So you may want to make a note of this right here. If it's not material but significant, again, no oil in the van, it's going to break down eventually if you don't fix it. Okay. That's going to be significant deficiency. And then material weakness is going to be something that's likely to result in a material misstatement. Reasonable, possible, or probable material misstatement in there. Now you'll notice here, all of these get reported to management regardless of severity. The first two, the top two, get reported to the audit committee, and then the last one, material weakness, that gets reported externally. It's actually included as part of our report on internal controls of our financial reporting. Okay, that's what that means. All right, so what are we going to be doing? What are we going to be doing as part of our testing of internal controls? And I'm trying to vamp here because I still see people writing down, and I don't want to add that advance, but let's go ahead and talk a little bit about some things that we talk about with respect to evaluation. All right. So there's 3 steps that the SEC has issued guidance on, which is very nice of the SEC, given how very vague they are in a lot of their respects. They actually provide some guidance in this. Here are the 3 evaluation steps. First of all, identify financial reporting risks and related controls. Secondly, consider what locations to include in the evaluations. And finally, evaluate evidence about the operating effectiveness of internal controls over financial reporting. Now, that's all well and good to talk about those 3 steps, but what does it really break down to? What is the approach? And the answer is it's not all that different from the auditing approach that we already know about. We're going to go through a very similar process. That being said, there are some unique aspects to testing for controls and some unique things we have to consider. So this is my caveat I throw out here. I think it's the next 1, 2, 3, 4, 5. Yeah, the next 5 slides. No, sorry. Yeah, 5 slides, and then a 6th slide that occurs about 3 later. So basically, when you see these items up here, this is really important stuff. This is stuff that I frequently test on, and for some reason, students see that framework and they just kind of like tune out, okay? So for the next 5 slides, plus another one that's going to occur a few steps later, make sure you take diligent notes on those and you spend some time studying that for the next exam. Because I think this is really, really important stuff. And I'm going to add some things that are not on the slide, so you probably should take diligent notes as well. So why the audit of internal controls or financial reporting and the audit of financial statements have different objectives? They must plan and perform the work to achieve the objectives as both audits of an integrated audit. Both audits have been integrated audit. So the idea is what we talked about before, the integration of these 2 ideas, the integration of these 2 approaches, the two goals. We want to conduct these basically simultaneously because information about one will give us detail about the other. Makes sense, okay? If controls are operating effectively, that gives us some assurance about the relevance or the accuracy of the financial statements. Similarly, if we believe the financial statements look good, then it's probably going to be a good signal that the controls are operating effectively. So that's why we want to perform these in an integrated way. All right. So we're going to walk through each of these stages, and we're going to talk about some general rules or some general thoughts that need to be included in each of these steps. So first of all, let's talk about planning. So in planning, the auditor is going to consider the following activities. Now, this is the good part, is that these are concepts that you should have some familiarity with because these are steps that we would include in planning for an actual financial statement audit as well. So the role of risk assessment and the risk of fraud. We want to make sure we assess the risk in the areas, particularly considering these are controls, which are supposed to be implemented in response to risks. We also want to make sure we understand what are the risks of fraud with the organization, because those are the intentional misstatements that controls are meant to be designed to avoid or to stop. We also want to know how we scale the audit. Some of the controls are going to be operating at different levels, so we do need to understand how we can perform tests of those controls if necessary, and what is the most effective approach. As we already know from the COSO cube, certain controls operate at different levels. Like control at a store level would be like the key in the cash register for the Taco Bell cashier. Okay, some of these controls are operating at the entity level, which we're going to talk a little bit more about directly. how do we test different controls? And the answer is this is going to be a goal of scaling. If we identify a control that's related to financial reporting, we need to understand what level does it operate and how do we test the control effectively so that we get a good enough representation for the organization. Finally, using the work of others. This is going to be something that our internal auditors will help us out with next week because they're going to talk about some of the work that they do. If at all possible, we would like to use the work of others. Interestingly, from 2004 to 2007, our external auditors could not use the work of internal auditors, which meant for a lot of work, but it also meant for a lot of money, which was a very interesting time to be an auditor on there. Nowadays, the external auditor can rely very heavily on the work of the internal auditors, and if the internal auditor's work is effective, then they can actually get a little bit of assurance from that instead of having to perform all the test work themselves. All right, this next one. Identify the controls to test. There's a lot going on in this slide, so this is a pretty important one to note. So very first step in identifying controls is to understand what are entity level controls. So have you all ever encountered the concept of entity level controls before? At least probably not outside of this course. There's never been really anything defined. In the COSO cube, it says there's controls that operate at the entity level, but what are those controls? The answer is you probably encounter those controls, but they've never been characterized as controls. So there's two that are very, very apparent, though they're not really considered to be controls. The first one is going to be the control environment of the organization. The control environment of the organization. That's a control in and of itself. As people take controls very seriously in the organization, then that means the rest of the organization will too. Also, there's another one that it makes a lot of sense when you think about it, but it's not obvious. That's the entity's period end financial reporting process. Why does an organization issue financial statements in the first place? Because there's demand from them, from external stakeholders, for making sure that they understand what the position of the organization is. So that process in and of itself is a control to make sure everything is going correctly, it's going properly. So the period end financial reporting process is another one. Those are the two major ones. Those are the ones that the book talks about, and they tend to be very significant. But entity level controls can exist at a number of different ranges. Two that I identified that I thought were pretty important were the code of conduct, or written code of conduct in place of the organization. And many organizations, especially in this day and age, have a whistleblower hotline for reporting incidents and fraud. So it doesn't have to be limited to fraudulent financial reporting, but it can be associated with anything that affects operations, which a lot of HR prevalence has taken precedence in that regard. So code of conduct, whistleblower hotline, all of those good examples of entity level controls. Then we identify significant account disclosures and their relevant assertions. That one's obvious because we've talked about that in the control sequence. We need to understand what are the accounts and the disclosures and the assertions related to those. Those are going to identify what the controls need to be. We need to understand the likely source of misstatement, and that's going to give us our list of controls to test. And that includes those entity level controls we identified before, because again, those can have a direct impact on financial reporting in the organization. If there's a bad control environment in place, then you're going to say there's a much higher risk of fraud, and therefore the controls themselves need to be much more prevalent to address that particular problem. So next, we need to evaluate and test the operating effectiveness of selected controls. So what are some considerations that we need to think about with respect to the scope of work that we're going to be, I think that's right. Scope of work that we're going to be testing. So first of all, we need to think about what are the types of audit procedures that we can perform. Now, this is both an indirect and a direct question, okay? An indirect question is going to be answered by that handout that I just gave you. We're going to walk through some of the steps, but directly speaking, if I ask you, what can you do to test controls? You should have 5 answers for me just ready and waiting, okay? Those are the 5 types of evidence we can collect for internal controls: inspection of records of documents, observation, inquiry, reperformance, and walkthroughs. So that's going to be an example of types of tests we can perform. How about the number of tests and the sample sizes? How many tests do we need to perform to gain assurance in this area? This is a question we cannot answer yet, but we're going to get a lot more information about on Wednesday. How do we actually approach that? What is going to be the most effective route? By the way, in this regard, if we're talking about transactions, the best answer would be test all of the transactions. And if you were talking to somebody about 20 years ago, they would say that's not practical to do. We can't test all transactions. We're getting to the point now in many organizations where testing all transactions, especially in smaller volume areas, is becoming increasingly pronounced. Now, I don't think I could test every single one of Amazon's transactions. I don't think I could do that on a daily basis, much less an annual basis. But we can gain information that will give us test detail about a lot of the transactions, especially if we're talking about a limited population. Even if it's millions of transactions, we've got data tools that will help us in that regard. Finally, our timing, which we have talked about, interim versus year-end testing. How do we actually determine when's the best time to approach our testing? And the answer is usually it's going to be both, especially if we're dealing with large data sets and large organizations. A little bit of both is going to be included. But let's go ahead and talk a little bit about how we would perform some testing in this regard. Like what would be the example of testing here? So let's talk about procedures testing. So you got a handout, which is Exhibit 7-3, and I believe it's still 234 in the book. Maybe it's 235. I got two different numbers here, but it's around 230 something. So this is for Bill Boyd, okay? And Bill Boyd is a manager at Emmons & Shin. I'm going to go ahead and pull this up here. And Bill is doing some testing over cash. And so he's testing, he's basically doing some procedures of the cash account for the cash received in the bank lockbox. Now, let's go ahead and first of all make a definition here, because sometimes we read through this and we think we know what everything means. So when I say bank lockbox, am I talking about like one of those lockboxes that Delta Sigma Pi uses for concessions? No, I'm talking about an actual bank lockbox there where cash receipts are received by customers sent directly to the bank, okay? That would be weird to actually do testing on the lockbox itself. It's like, does the key fit? Okay, what type of metal is it made of? Yeah, it's just kind of strange. But anyway, for the bank lockbox, he's identified some procedures or some controls that are in place. The entity receives in the bank an electric filing listing of cash received from the customers. So anytime that the bank receives cash, there's an electronic listing that matches up. The IT system also applies cash received in the lockbox to individual customer accounts. That's an IT function, which basically says that anytime a transaction is received, it does its best to match it up to what the appropriate transaction should be. And then any cash received in the lockbox not applied to a customer's account is listed in an exception report on the unapplied cash exception report. So if the cash or the IT system looks and says, I've got a cash receipt that I can't match to any current transaction, I'm going to list that as an exception. And so the application of the cash to the customer's account, this is a programmed application control. Okay, so this is an automatic control right here that basically says we're going to match the transactions up. The cash receipts get matched up to the transactions, and the review and follow up on applied cash exception is a manual control. So Boyd wants to determine whether misstatements in cash, primarily related to existence and accounts receivable, which existence and VAA and completeness, would be prevented or detected on a timely basis. To test these objectives, he's going to test the manual control. Now, it's important to note, in reality, if we were going to be testing this, we would test both controls. We would test the automated control and we would test the manual control. We're just going to talk about the manual control because that's a little bit easier to conceptualize. But the automated control would be a perfect example of how we would perform a walkthrough if we were to test this. We would see, can we identify a cash receipt that's been sent in? Can we actually see the process of the system applying this cash receipt to a transaction? And what happens when a receipt does not get assigned to it when we walk through the manual control? So the automated control is still important. I don't want you to think that this is that's being ignored. This would be tested as part of this. But in order to test some of the bigger concerns about what happens when a cash receipt does not get applied, he wants to test the manual control. Now, let's just talk about the logic behind this real quick, because this is really important. Why might a cash receipt be received but not applied to a transaction? Is it possible that a customer could send us an amount different from what we think they owe? Yeah, it happens all the time. So say, for example, they have a cash discount. The easiest way to think about it is like a cash discount. Remember that 210/N30? Okay. And so we don't receive a payment within 10 days. So we say the net is due, but they sent the payment, it just got delayed in the mail or it got delayed in transaction. So they took the 2% discount, they try to apply it and it's 2% less. And the cash report says, well, this says $998 and this is or $980. They owe us $1,000. There's no match here. I can't figure it out. What would have to happen in that situation? This is where an individual would step in and try to reconcile the problem. Say, oh, there's a 2% discount here that got applied. I don't know if I need to check and make sure that 2% discount is valid. Otherwise, they still owe us $20. But if it's valid, I can go ahead and just apply it to this transaction for the discount. So that's basically what's happening here is the exception report is trying to have somebody investigate the reasons why certain transactions don't match. Occasionally, it could be that somebody sends in cash for a transaction that you just can't find in the system. And it's possible that transaction did not get recorded. So that's why we're talking about completeness here, is that we want to make sure that the transactions themselves also get recorded and the cash comes in for a valid transaction. So what is he going to do? All right, so he decides to perform the following tests or controls to assure the operating effectiveness on the control for review and follow up on a daily plan applied cash acceptance report. So he inquired of entity personnel about the procedures in place to ensure that all unapplied items resolved in the time frame with resolution takes place, whether unapplied items are handled properly within the system. What did he find? Well, he talked to the employees responsible for the reviewing this, and he said that typically reports a resolution in the next business day. In most cases, it appears that unapplied cash exception report relate to payments made by customer who failed to reference an invoice number or a purchase number, or to underpayments of invoice due to quantity or pricing discrepancies. So kind of the reasons we were talking about before. There may be a lack of information, or it could be that the amounts are different, but kind of logical and makes sense. So that was a pretty good inquiry, right? All right, so we can move on in our slides and we can stop talking about this, right? Why would I ask that question if I said the answer was right? Yeah, so answer is no. This is an inquiry step. What do we have to do with inquiry and observation? Corroborate. We have to corroborate all that information. So Bill Boyd is a good auditor. He says, I'm going to reperform the control. He selected 25 exception reports at random from January, September, and performed the procedures they followed, and basically said, I'm going to make sure that I get the same results that the employee did. I'm going to reperform the testing for 25 random days. And if I have the same results, if I have the same applications that this employee does, then I'm going to be satisfied this control is operating properly for that period. All right. So reperformance, that's a good corroboration mechanism, right? All right. So we can stop talking about this and move on our slides, right? Anybody who's reading the documents, no, there's more information on there, Dr. Barnes. What are we missing? What's missing here? So there's a problem with just leaving this as is. January to September is not the entire fiscal year. We do need to know, is this control still operating the same way it should be at year end as well? So Bill Boyd still needs to come back in at December and reperform some additional tests on some areas, some transactions that occurred during that period to make sure the control is still working properly for the I forget what the term of that period is between interim and year end, but that period, October through December. There's a term for it. I'm just blanking on it off the top of my head. See, that's what happens as you get old. You forget things. Okay. Like I don't remember anybody's name right now. So yeah. Anyway. So yeah, forgetting that term. Basically, we're talking about October through December. Roll forward period. That's what I meant to say. Roll forward period. So that roll forward period, and now I remember everybody's name now. So roll forward period is going to be tested and make sure it's accurate. Based on the procedures, Boyd concluded the employee was clearing exceptions in a timely manner and control was operating effectively as of year end. So does that make sense to everyone? We had some inquiry about, or some investigation into what the nature of the control is, identified a specific test, performed those tests, inquiry, and then a reperformance to corroborate, and made sure that the reperformance was reperformed or redone at year end. So there was a follow-up and follow-through, and I think the control is fairly effective in that regard. So a good example of how we would perform a test in that area. All right, moving on. Oh, am I free to move on the slides now? Hopefully so. I can't think of anything else. We're at the end of the piece of paper. So now we need to identify control deficiencies. And as we talked about, they rely on two factors. The possibility the company's control will prevent or detect a corrective material misstatement. That's likelihood. And the amount of potential misstatement resulting in the control deficiency, that's magnitude. Remember, our criteria on determining that is based on first likelihood, secondly on magnitude. So let's go ahead and make some assessments ourselves. So I'm going to go ahead and tell you right now, I do not necessarily like the questions that we're about to ask you all. I'm also going to close the door. Somebody started cheers when I said consider a mistake. All right. So in the book gives you, this is going to be true for the homework as well, by the way, which makes things a little bit simpler, but the book gives you a couple of options. The couple of options we're going to look at is it's either going to be a significant deficiency or material weakness. Those are going to be the examples we're going to look at, so it's one of two. There's also homework assignments that it's going to ask you if it's a significant deficiency or material weakness. For the exam, the scenarios that I will give you, there are going to be four possible options. There's going to be the possibility of a control deficiency, possibility of significant deficiency, material weakness, or none of the above. It does not qualify as a control deficiency based on like the lack of likelihood from occurring. Okay. So you have to keep in mind there's a lot of possibilities here, and you need to be responsible for all of them, even though the book is limited in its representation. That being said, let's go ahead and look at our couple scenarios that we have. So again, these are either significant deficiencies or material weakness, and we have to justify our decision. All right. Murray Company processes a significant number of routine intercompany transactions on a monthly basis. Individual and company transactions are not material and primarily relate to balance sheet activity. For example, cash transfers between business units to finance normal operations. A formal management policy requires monthly reconciliation of intercompany accounts and confirmation of balances between business units. However, there is no process in place to ensure performance of these procedures. As a result, detailed reconciliations of intercompany accounts are not performed on a timely basis. Management does perform monthly procedures to investigate select large dollar and intercompany differences. In addition, management prepares a detailed monthly variance analysis of operating expenses to assess their reasonableness. Now, we didn't really need that second paragraph to answer the question, but I do want to note that if we were evaluating all four criteria, that we would probably say that there's a control failure here, a control deficiency, and it's going to be at least significant based on the criteria that we have. The question is it significant enough to be material? What do you all think? Those words not material were a pretty big clue, weren't they? Yeah. So not material is a pretty big clue. So this is going to be a significant deficiency. Let's look at one more. Ragunan and Company processes a significant number of intercompany transactions on a monthly basis. Intercompany transactions relate to a wide range of activities, including transfer of inventory, intercompany profit between business units, allocation of research and development cost to business units, and corporate charges. Individual intercompany transactions are frequently material. A formal management policy requires monthly reconciliation of intercompany accounts and confirmation of balance between business units. However, there is no process in place to ensure these processes are performed on a consistent basis. As a result, reconciliation of intercompany accounts are not performed on a timely basis, and differences in intercompany accounts are frequent and significant. Management does not perform any alternative controls to investigate significant intercompany account differences. So a very similar scenario, but what's the big difference between this scenario and the last one? Aside from the words frequently material, or what are some other differences we noticed? So there were remediating controls in the other one. Keep in mind that we did have a control in place, but there's no way to ensure the control was taking place. But management did a review of or select large dollar company amount or intercompany account differences, and they also prepared a detailed monthly variance analysis. So there was a little bit going on here, kind of as a redundant control. Are there redundant controls here? No. So if it's a failure, it's a big failure, and we know it's big because they are frequently material. They occur frequently. And they're significant, they're material. Actually, significant is a bad word. This is the book's word, not mine. We know that not just significant, but it's material. So yeah, certainly a problem here, which means this is a material weakness. Yes.
Like on these slides, like on video.
Oh, yes, yeah. So I read those really quickly because the details tend to be very, very obvious and people can read just so I click. But yeah, this is one of those ones. Although I've been told that slowing me down to 0.75 is just about right. Okay, so 0.75. I do sound a little bit drunk when I wrote 0.75. Yeah, blurring my words a little bit. All right. So what happens when there's an internal control failure? Well, if we're talking about a material weakness, we're looking at a situation where it may require remediation. Now, remediation is the process of correcting material weakness in internal controls financial reporting. We talked a little bit about that. One of the reasons why interim testing can be helpful is that it will allow a management to remediate the problem. Now, remediation will not fix the period for which the control was operating. So if they fix the control at half of the year has already passed and that control was still functioning badly for the previous year. But for the last half of the year, we do note that the control is still is operating correctly, or whatever period it takes for management to control or fix that problem. So there are at least some ability there. Now, what is going to be the requirements with respect to remediation? And we are very strict with remediation of material weaknesses from the audit perspective. So if a material weakness is corrected before the as of date, and usually when we talk about as of date, that's going to be the last day of the period. So we're talking about December 31st, 2025 for this fiscal year. So the balance sheet date, I guess I probably should just say. There must be sufficient time for both management and the auditor to test the operating effectiveness of the control. So what does that mean? What is this phrase saying? Saying remediation requires several steps in order for it to be effective. If that remediation has to take place, okay, the fixing of the control has to take place. Management has to test the control to make sure it's been corrected properly. And the auditor also has to test the control. So 3 steps: fix the problem, management test, auditor test. All of those things have to take place before the as of date in order to make sure the control is operating effectively by year end. Okay. Now, what does this mean? What if management fixes the control, they test it, and the auditor does not have time to test the control year end? Well, that means that as of year end, we still have a problem. That means that we're going to issue an adverse opinion, which we're going to talk about when we issue an adverse opinion. But basically, it comes up when a material weakness comes up. There is still a material weakness from the auditor perspective because the auditor has not time to test the control. Even if the control is operating properly, we don't know that. We have to test the control before we can make that decision. It's important to note that there are some situations where we can fix that problem. Now, after auditing the effectiveness of internal entities control, an auditor issues an unqualified opinion if the entity's internal control is designed and operating effectively in all material respects. All right. So if we look at the controls and the controls are great, there are no control failures, no control deficiencies, we can say, well, unqualified opinion, we just move on. But that rarely happens. So what are the criteria for issuing different types of reports? The good news is this has not changed much from the financial statement reports, financial statement opinions. There's basically 3 types of opinions we can render as an auditor. We're going to eliminate qualified opinions. There's no such thing as a qualified opinion over a coffer. So if it's just a control deficiency or a series of control deficiencies, remember those are small problems. That's the dirt in the corner, the vacuum mist. That's still an unqualified opinion. Also, significant deficiencies generally also still qualified for an unqualified opinion. I realize that was really weird worded. You generally are going to be unqualified opinions. Why? Because they're not problems yet. All right. They are problems for the future. They should be corrected, but they're not affecting the current period. They're not likely to result in a material misstatement in the current period. If it's a material weakness, however, material weaknesses by definition are likely to result in material misstatements. Therefore, we're going to issue an adverse opinion. Similar to the concept and the philosophy we talk about audit of financial statements, the financial statement audit. If it's a material misstatement, it's an adverse opinion. If it's a material weakness, it's an adverse opinion. They also have the issue about what happens if the auditor is not able to draw enough evidence for a conclusion. Remember that scenario we talked about scope limitations? These can exist for internal controls or financial reporting as well. If we have a control limitation that has more than one minor effect, then we're going to disclaim our opinion, or in some situations, we may withdraw from the engagement because we can't complete the engagement and issue the report in time. Usually this only occurs in very large scope limitations for very large clients, simply because we as auditors are required as part of the testing or to issue that report as part of testing. So it's not common that this happens, but it happens occasionally. All right. Couple more slides, some other reporting issues. What about subsequent events? Well, we're going to wait and talk a little bit about subsequent events for chapter 17. Now, subsequent events actually has a different definition from this perspective. All right. It's important to note that anytime there's a change in internal control, if the auditor is still being engaged by the client, they are responsible for reporting on that. So let's say we reach year end and we're still auditing in the middle of February, and then we become aware that a control failure has occurred that affects not the period under audit, but the period which is currently taking place. Do we as auditors have a responsibility? This falls under subsequent event criteria. Remember subsequent events from 303? Subsequent events are events that are significant enough that shareholders want to have information about them, or stakeholders want to have information about them. We consider that to be criteria for subsequent events. We're going to talk a little bit about it in chapter 17, but basically this means that if a control failure occurs, even if it's not the period under audit, we have a responsibility to report it as auditors. What if the auditor decides to refer to the report of other auditors, which this happens quite frequently? We're going to talk about how we modify the audit report for that. It goes without saying that any modifications to the financial statement audit report will also occur to the report over tested controls, report of our internal controls over financial reporting. What if management's report is incomplete or improperly presented? All right, what if that's the case? So remember, management has to issue their own report. And presumably, they know how to do this. They've been doing this for a very long time. They're all very expert. But what if they issue a report that doesn't have certain information in it? They left it out because they didn't want to be scrutinized, or it's not presented in the way that it should be presented. Basically, we're going to modify our reports, our internal controls, our financial, our opinion. We're not going to modify our opinion, but we're going to modify our report to explain that management's made some mistakes. So we're going to add a different additional language to the report to say, yeah, management, their report is not correct. It should say this, but it actually says this. What if management has a perfectly good report? They've got all the complete wording and they got it's properly presented, but then they can't add additional information that's not necessary. So they have a report, it's all correct, except they add additional wording. It's technically correct, right? Yeah. So manager's report is what we're responsible for as testing as auditors. But if they add additional information, that's information that we as auditors did not test. Therefore, we disclaim an opinion, not on internal controls, but on the additional information that was presented by management. We're basically going to say, look, the report is complete. It contains accurate information, except some of the information is outside of the scope of our testing. We do not have an opinion on this information. We did not issue an opinion on that. Finally, something that's important to consider. Remember I said that a remediation has to take place before year end, before the as of date? All right. What happens if they fix the problem? We can't test it as auditors, but we get some time to test it after all the auditing's taken place. Should we still just leave that as an adverse opinion? The answer is no. If we can remediate at a future point in time, we can go back and change our opinion. We can say the control has been remediated. Therefore, we no longer believe that there's an adverse, we no longer have an adverse opinion on internal controls. We now believe that we have an unqualified opinion because the control has been fixed. It's important to note that this remediation has to be transparent because it still affects the period under audit. But if it does get fixed, we can withdraw our adverse opinion as long as we actually exclaim the reason why we're withdrawing the adverse opinion. As long as we actually explain it. I should not explain. All right, last slide. Second to last slide, because I've also got this one right here, but that's not really a slide. All right, so the auditor must communicate in writing to management and the audit committee all significant deficiencies and material weaknesses identified during the audit. This communication should be made to the prior to the issuance of audit reports on internal controls or financial reporting. So what this is saying is that anything that's a significant deficiency or a material weakness has to be communicated to both management and to the audit committee in writing. This also doesn't say it, but you should note that material weaknesses do need to reported externally. All that means is this: we're going to include any material weaknesses on the auditor's internal or auditor's report, their report on internal controls or financial reporting. But what about the control deficiencies? Remember, control deficiencies are the things that are not big problems. Okay, they should be fixed. They're issues. They're not issues significant enough to affect the opinion. So the auditor is going to communicate this information to management. All control deficiencies identified during the audit. Now, do we share control deficiency information with audit committee? The answer is kind of. Okay, we don't tell them what the control deficiencies are. Imagine you're a big wig, you're on the board of directors in your audit committee, and you're retired, and you're just kind of like, okay, I just want to know what the big picture items are. It says, oh, well, there's some dirt in the corner over there. You're probably going to get a little bit upset with the auditor. Okay, so we don't actually share with audit committee the individual control deficiencies because they're so small that they're not really relevant to notice. However, we are required as auditors to tell the audit committee when we communicate this information to management. So the audit committee is apprised of this communication taking place, but we don't give them all the details. It's basically like telling the audit committee, hey, I told management what the control deficiencies are. You can rest your mind, all that stuff will get vacuumed up in the corner. That's actually an analogy I've never used before. I'm not sure why I'm so strung about it today. I think maybe I'm just looking at that chair over there. All right, we're done for today. Chapters 8 and 9 on Wednesday. I'll see you all then.